All right, welcome back to the R&D room live. So we are going over a R&D strategy here using 10% of my account. I'm going to be doing 0 days to expiration, trading potentially the SPY or maybe futures because I have a small account. And the question is, can I develop a profitable strategy just with my small account, trading small and collecting gains throughout time? So I placed my first trade today. I took a chance on it, and we'll review that trade. I was able to screenshot and record the trade through its entirety. I didn't get all the footage that I wanted on it, but we can at least review it and see how it played out. What I did was an iron condor, and so the current price at the time, this is a recording here, was 554.53. So I did a 553 put that I sold, a 558 call that I sold, and then I had $2 wings on the outside. So I tried to mimic the trade that we were looking at the last time. So that it worked out pretty well. I don't know if it was exactly how I had it planned, but I was able to manage my risk by keeping the risk small. So I opened the trade. Let's see here. Yeah, here we go. This is a good visual. I was hoping that I got this on here. So I opened my iron condor, and you can see it was right there in the middle. It was actually 550. It wasn't 554. It was more 555 to 556. So I opened the iron condor. You can see it here, down here where the strikes are. And then I set my price to 25. No, it was 20% profit. So I was just testing this out, doing a small. I know that the 20% profit target had good outcomes on the studies that we saw. And so I pulled the trigger on this. And then throughout time, I just left it on record and went through it. And everything seemed to go pretty well. I don't even think it was in the red at all whenever I had opened the trade. It just gradually lost value, and it might be hard to see in this recording, but right down here, you can see that the price goes down over time. So my limit price that I'm wanting to get out of the trade is 49. I think I opened the trade at around 62 or 61 cents. So I think I might be a little bit in the red right there, but you can easily see throughout time, it goes down to 54, goes down to 50. It's around 56, 54, then it drops to 49. And it was after about an hour that it actually hit my target and I was out of the trade. So you can see the exact moment that I got filled. And I like how I was able to record how the trade played out throughout time. And actually you can see exactly where I got filled. And pretty much what I did was I opened up the position. It was around like 9, maybe just after 9 or whatever. And then once I opened the position, I pretty much just left it alone. And I know from previous times that I tried the 0 days to expiration, I know that if the trade is going to work, it's going to work within an hour. If you have a trade open and it's going south, you're in the red or whatever, and the price is moving, to me, I'm feeling like, and I don't really have any studies to back it up, but I'm feeling like if I can go back and just no matter what at a time limit, if I'm past an hour or if I can close the trade early, then I can keep my losses smaller than my max loss. And you have to be quick with these 0 days to expirations because once they move against you, they can move pretty quick. So I'm almost wanting to take off the trade after a certain time frame during the day. And I'm thinking somewhere around an hour, hour and a half, get out of the trade because it can only get worse. And there's an off chance that it could get better throughout time, but I don't want to hold and hope. I want to be able to get out of the trade, realize the loss, and keep those losses small. And so that's the name of the game with trading, is to keep those losses small and then move on to the next trade. I'm looking to just do one trade because when I did actually get filled here, my day trade counter went up to 1. And so I know that I can only do 3 trades a day trading the SPY. Now I can go over to the futures contracts, and that won't be a problem. But that does add a couple dollars to my fees, and I collected $12. I think you can see. I don't know if you can see it on here. No, I don't think it shows. I ended up getting $12 on this trade. And yeah, you can see 61 minus 49. So I got $12 there on the trade. And then with commissions, though, it was more like $6, $6 to $7 because of the Iron Condor. There's a lot of positions there. You've got, 2 call positions, 2 put positions. So it usually totals to around $4 or $5 there. That is a factor in how I'm doing these trades. And it's going to be more like $6 in commissions whenever I go to futures. So I have to be mindful of that. It's not going to sway my decision because I'm wanting to learn how to do these trades on a very small scale to gather learnings, to share with you what I learn, and to see if I can be successful in these trades or not. And what is the best strategy for that small account? That's really what we're going for. Okay, so let's take a look. Yeah, I think I'll pull it up here on the screen so you can see the trade that I did make. 49, and then I was able to close. Or I opened it at 61 cents and was able to close at 49. I also opened up a call. I believe it's a call spread on SPY on my credit spread strategy that I'm trying out as well. So I've got that in the works. So we got a couple episodes to go over. I thought were interesting. I haven't watched all of them, but they look like they apply to my strategy on 0 days to expiration. So we can take a look at that and maybe jot down some notes as we go along if it applies to the strategy. So the name of this is How We Use Iron Condors, which is what we're trading, to maximize 0 days to expiration's profit. So that's what we're really aiming for.
Capital efficiency for 0 DTE positions. Capital efficiency for 0 DTE positions.
So is anybody going to, I think people are going to binge watch this 0 DTE series.
It's possible. We've been doing it every Thursday.
I think it's likely.
Let's go to the next slide. So as we discussed the last few weeks, we usually prefer defined risk trades in 0 DTE options. Now, when I use defined risk trades, some things because I don't do virtually, I hardly do any defined risk trades. And when I do 0 DT options, I do almost exclusively defined risk because I can't see tying up. Just think about this for a second. A short strangle in the SPX is about one lot. It's about $80,000. That's not our requirements. That's just the exchange requirements because it's a little under 20% of a $4,000 index.
Yep.
Okay, which just to figure out, that's about $80,000. So say it's even 70,000 if you do a, whatever. It's still a lot. It's still a crazy amount because you can only make a couple bucks.
The return on capital stinks.
It's only for one day, but it's still it's too much capital. So you do define risk, and at least you don't have to deal with that. So as we discussed, we usually prefer defined risk trades in 0 DT options, and we almost never trade undefined risk. If you're going to use something smaller like XSP or SPY or something like that. One of the reasons is capital efficiency. Let's compare the capital usage for 0 DT options, and then we'll compare the same trades on a 45-day cycle. Okay, let's give it some context. First slide. So we just studied. We compared the capital usage of the following for 0 DT in 45 days. 25 Delta Strangles, 25 Delta Iron Condors. When we say 25 Delta Strangles, that's a short put and call 25. We say short 25 Delta Iron Condors, it's just the same exact strangle, but this time with $2 wide wings for the 0 DT and $15 wide for the 45 days. We compared further out wings to the 5 deltas, and then both Iron Condors collect a credit of 1/3 the width of strikes.
Yep.
Okay, pretty straightforward. Let's go next slide. The short strangle in the 0 DT cycle has a greater buying power reduction than the same delta in the 45-day cycle because the 25 delta strikes are closer to the at the money for the zero DTE. Makes perfect sense. By capping our risk with an iron condor, we can get a 98% reduction in capital usage that is more accurate of the risk that you actually incur. So here we go. Zero DT buying power. The strangle requires, and this is in SPY.
Yep.
So this is 1/10 the size of the SPX. Now, the reason we like SPX or XSP is because it's cash settled. You don't have to deal with anything at the end of the day. You don't have to worry about anything. Everything just settles.
Right.
But if you're using SPY, which is not cash settled, $7,763 for one strangle.
Yeah.
And Iron Condor is $122.
That's crazy.
So the capital reduction is 98%.
Yep.
And if you're doing 45 days, which is our normal wheelhouse, it's 6,300, so it's less. The Iron Condor is 995 because it's wider. And the buying power, the capital reduction is 84%. So you can make it at the 45 days. There's at least a discussion.
Yep.
At the 0 days, there's no discussion, right?
No.
Okay.
Nope.
Okay.
It's pretty clear because if you do a 25 delta Iron Condor, you're closer to the money because your expected move is very small. So you're not moving very much, and there's not a lot of time there. So you can see the savings are pretty good there on capital, which you can expect that, right? If you're putting a defined risk trade on, you're going to be able to reduce your capital usage versus a undefined. But even against the 45 days to expiration, it's better.
Let's go to this is the next slide, John? Yes. Zero DT options have low capital requirements across the board when defining risk. Because of the stark difference in capital requirements, there's a larger incentive to define risk in zero DTs than with longer durations. So we're going back to the same kind of discussion, but this time we're looking at 25 delta short Iron Condors with long wings instead of 3. We're giving you different examples. So when you look at the strangle, the first line, it's the same as it was before, of course. But then when we go to the 25 delta short Iron Condors, and you look and you compare the difference in the zero DTs. Let's see, just hold on. Let's see 1 second. So, yeah, I mean, when you look at the zero DTs and you compare them to the 45 days, I mean, it really doesn't make sense to do anything but define risk.
So let me explain what's going on underneath here a little bit.
Okay, sure.
The key is that margins, and not portfolio margins and not futures margins, but regular stock options that SPY has are price based. Okay, so it looks at the price, just like Tom did when he's talking about SPX. You take a $4,000 product, it's roughly 20%, 80%, that sort of thing. That's price based, not volatility based. They did this back in the 1930s or whatever, when people were figuring out margins by hand, a bit of pencil and paper, and all they were doing was stocks. Okay. But what it means is that the price is the same of the spider, whether you're looking at 0 days or 45 days. It doesn't take into the real risk of the position. It's saying, look, it's just this $400 product and the margin is X. And when you buy the wings with the 0 days to expiration, with those 5, 10, and 16 delta options, which you're selling the 25s, they're much closer. Why? They're much closer points. Those deltas are tighter in because you have almost zero volatility left in 0 days. 0 days, very low volatility. You can buy those options. You can buy those 16 delta options for very little money. As you go out to 45 days, those 16 delta options get richer. They're more costly. Okay, and you push them further away from your short strikes to get that 16 deltas. That's why the margin is so much greater. So as Tom was saying, yeah, I can compare, there's a big difference between, let's say, looking at the 45 days between $6,400 for the short strangle and $752, $1,654, $3,497. I get it. It's cheaper with the iron condors. But as we were saying before in the discussion about the wings, you may want to just allocate, 3% to that short strangle versus 1% to the iron condor, or less than 1%, because again, you'll make money a little bit faster in the strangle, easier to manage, easier to roll than an iron condor. But when you're looking at the 0 days, the dramatic drop in buying power requirements between the strangle and all of those iron condors just doesn't make sense to do 0 days options.
Let's be fair, because the short 25 delta, just so you know, on the 0 DT, it's a very inexpensive option.
Right.
So statistically, the chance of getting there, you're not making a lot of money on short 25 delta with 25 delta with 1 day to go. 0 DT today is probably in the neighborhood of 40 cents.
Right.
Okay, just to put some numbers. When you go to 45 days, you're talking about what's 45 days from here. Right now I'll go to 43 days, and you're talking about the 25 delta option is $3.75. Let's say. So $3.75 versus 40 cents. That's why.
Different.
But again, for purposes of just explaining this, that's why we do defined risk short term and undefined risk, and undefined risk longer term.
Right.
Okay. Let's go to the next slide. So to make an extreme comparison, in the 0 DTE, you could define your risk with the nickel bid options and still put up 87% less than a naked strangle. In the 45 days, the resulting capital requirement for this setup is 3 times larger than for undefined risk. So it's a little bit weird that when you buy the cheap wings in the 45 day, it actually costs more than the naked position. Okay? Because it just costs more for the naked position. But when you do it in the 0 DTs, you save a lot of money. So the whole point of today's exercise by the research team was just to say, when we're trading 0 DTE, we're inclined to use defined risk because it makes sense. And when you're trading the 45 days, we're inclined to use undefined risk because that makes sense.
And to just add this is that when you're working with 0 days, there's no adjusting, there's no managing that trade. These aren't binary options, which is a specific things, but the events tend to be binary. That's my point. There's
very little you can do late in the day. By the time the move happens, you're kind of trapped like a rat.
You're done.
Yeah.
It's the trade.
I've talked about that before. Once you get to 2 o'clock in the afternoon, you're pretty much done.
Nobody wants to trade with you.
No, there's nothing you can do, and you're just at the mercy of wherever the close is, which for some people that's cool, and for other people that's not cool.
Right.
Let's go to the takeaways. Because of how buying power for undefined risk is calculated, there is a large incentive to trade defined risk in 0 DT options. I hate the word irregardless, so we're just going to say regardless of the risk of the strategy itself.
Oh, we didn't catch that.
We missed it. Undefined risk trades are actually more buying power intensive than 0 DTE trades than any other cycle because of the strike proximity to the at the money. It's correct. Conversely, defining risk in 0 DT options is significantly more capital efficient because of the cheaper out of the money wings, which is what you said. Plus, when you buy cheap out of the money wings, you're not giving anything away because you don't feel guilty.
Right.
I feel guilty when I pay $4 for an out of the money wing.
Right.
I don't feel guilty when I pay a nickel.
Right. Because it's I'm buying this premium.
Yeah.
Why am I doing that? Interesting.
Anyway, I think really interesting and a good, a really strong takeaway, which is the last 2 pieces were really strong takeaways. The option jive piece is always, fewer contracts, wider strikes, and just be smart about the amount of buying power that you're allocating. The market measure today was about Zero DTE makes a lot of sense to use defined risk, makes less sense to use undefined risk, but 45 days makes a lot of sense to use undefined risk and less sense to use defined risk.
100%.
Beautiful.
100%.
And so really they go in really deep to explain that point, but ultimately what you want to do, what I want to do with my 0 days to expiration strategy is to use that defined risk because I can limit the amount of losses that I have. And like they said, it tends to be binary. Now they're not binary options, but the outcome is binary within that trading day. So to limit your losses in that is a key to be successful, I believe, and to continue to collect that consistent profit. And to try to get a third of the width of the strike too whenever you're trading 0 days. I didn't have that today. I think it was slightly less than a third of the width of the strike. But even though I'm trading with small size, and with that small size, I'm paying those commissions, and so that is limiting my profits when I win against whenever I lose. So I'm not worried about actually making money here. I'm looking for a strategy and learning how to work that strategy in a very small risk environment. So that was a good explainer there, a good reason why we actually would want to use a defined risk trade in 0 days to expiration. So I'm going to be sticking with that iron condor or the iron butterfly of some kind of defined risk where I know that when I lose, I have the potential to lose my max loss that day. And I try to limit that by closing the trade early if I have a feeling or after a certain amount of time frame to get out for a loss before it gets worse. Because you can still save yourself with that little time, that little bit of theta that's left in that contract to pull out. So that's kind of my game plan there with that. The next video here, comparing 0 days to expiration strategies on a volatile day. So I haven't seen this video yet. It's 20 minutes. We can take a look at that, and that'll be our last video.
Doing our 0 DTE segments, right? And, as we're building out our data set, we got some really good content that we're able to do now with just, like access to more and more data. And today what we're going to do is, we're going to put together the kind of the segments we did in the last few weeks and put them all together into one segment. And what we're going to do is, if you remember, we talked a lot about strategies, right? Mm-hmm. We talked about those butterflies last week. We talked about long puts and calls the previous week. We talked about short strangles the week before that. And now what we're going to do is we're going to put them all together and compare all of them on a very apples to apples case. So okay, if you have the risk of one strategy being this and the risk of another being this, what does it look like over the course of the day, right? Mm-hmm. Because now a lot of people, as they start trading these, have developed kind of their own way of trading, right? Some people trade butterflies, some people just do the naked call, some people do spreads, right? Some people do iron condors. So what are the risks of those comparatively, right? And the beautiful thing is, if you go to the first slide, John, if you go to the beautiful thing is that yesterday was a perfect day to test all these out with live data, right? Now, the reason we kind of have to do it this way, okay, when we're talking about this way, I mean we have to look at one day and we have to do a comparison of whatever we're doing, like our study set has to be usually one day. Now, the reason I say this is, some people may be like, well, why aren't you doing it over time, right? When we do 45-day strangles, we do over the course of time, from 2005 to present. And these studies, you've noticed we've been doing daily studies. And the reason is because the actual context of the day matters significantly more for the 0-day options than the 45-day period does for the 45-day options. In other words, there's a lot more variance on a day-to-day basis than there are over 45-day bases, right? So one 45-day period to another 45-day period isn't all that much different when you talk about the long term, as is a single day to the next day to the next day, especially if you're closing out the trade in the same day that you're putting it on, right? So in other words, look at Thursday, right? Yesterday was an insane day, and perfect enough for this study was a lot of action, two-sided action, moves greater than the expected move, intraday moves that were exceeding 60, 70 points in the even the S&Ps, right? This was a perfect day to test these strategies. Now, you go back to a day a couple weeks ago where you may have had a range of 20 or 30 points. Well, that's a totally different day with completely different results So the reason that matters is because when you're trading, you know the expected move for the day. And as you know, the expected move for the zero DTEs can be anywhere from 20 points to 100 points. Whereas when you're trading 45 days, the actual range as a percentage between 45-day periods is much smaller. So that's why over time, you can do those 45-day studies over years, whereas these, the context matters. So you want to put the context of the day into. Does that make sense?
Yeah, what you're saying is that the outlier days are more important to look at because the non-outlier days are pretty easy, right? If you're selling strangles or doing iron condors and it's inside the expected move that day, you make money on that. It's pretty cut and dry. With longer duration trades like your 40 or 50 day, iron condors, the stock can go down over a longer period of time and you still make money on that position. So the data set is really focused on the outliers because that's really where, the difference in the data comes into play.
So that's actually correct. So that's actually the first takeaway, yes. But I would even go further and say, and I just kind of thought of this example in the way kind of I would like to say it is, think of it as if you have a day where you have a lot of price action, right? Most people who are going to trade these trades, because we talk about these are supposed to be more engagement trades or trades that people trade if you see something happening. Usually people will not trade the zero DTEs every single day, no matter what. Right? For our 45-day trades, we will, because we will hold a position almost all the time in some kind of underlying for 45 days. With the 0 days, right, I'm going to guess that most people would rather trade days like this than a day where the market doesn't move.
Yes.
Because people don't have to, if you're talking about a core position, right, you don't have to have a core position in the 0 days every single day. So if you're going to pick and choose, you may as well pick the days where there is a large expected move or the day after the Fed announcement, right? Now, we have the data to do it every single day, but what you're going to get is this, and those studies will come, by the way, but the context of the study is to compare the risk between strategies on a day where you have a ton of action. And in this case, we want to take a look at a specific day because that's, if you have a day with a ton of action, you don't get all days to have that, right? You only have a handful.
It also perfectly articulates why when you look at near-term cycles, they have more implied volatility exposure in premium. Like GLD is a good example. 28-day has an expected move of 787. The 56-day, twice the amount of time, has an expected move of 1047, not 15 and change. It's not linear.
Right.
It's more front-loaded because of this, because you have more volatile periods from a day-to-day standpoint compared to, like you said, separate 45-day chunks.
That's right. And not only is it on average more volatile, but it has more variance in the volatility, which is why the context matters so much more, right? It's like you can have a day, like I said, in the E-mini S&Ps, where you can have an expected move of 20 points or 15 points on the 0 days, or you could have 100 points, as we saw the day of the Fed announcement, right?
Yeah.
On the 45-day cycle, you may have an expected move of, call it 150 points, ranging between that and 200 points.
Yep.
But that's much smaller range as a percentage of the range itself than are the 0 day options.
Yep.
So it's a good point to make. Okay, so let's go to the next slide. So we're going to talk about here is we look at these 0 DT strategies independently over the last couple of weeks. Right? We looked at strangles, we looked at long options, we looked at butterflies. Right now, I want to compare the risk and exposure on a day that saw significant two-sided action and an intraday move that exceeded expectations. This is a day where if you were a 0 DT trader, this was the day you were looking for, in my opinion. Right? You had all types of action. You had kind of calm action in the morning. You had significantly whippier action in the afternoon, and the actual move top to bottom was like significantly more than was expected. So, and you got multiple two-sided action moments in the second half of the day, as we saw, the huge rally in the second half and all that stuff. So That being said, let's take a look at the study on the third slide. So we're going to go and look at SPY, the intraday options price data for this day. Now, keep in mind, this is quite a bit of data because we're going to look at all of these strategies: long call, long put, long at the money call spread with a $2 wing, long at the money put spread with a $2 wing, a long call butterfly with $3 wings, a short 25 delta strangle, and a short 25 delta strangle, iron condor with a $2 wide wing. That's a lot of data, and we're going to look at it every 10 minutes. So we have intraday price data every 10 minutes for this day, and we're taking a look at all these strikes on this day. So realistically, this is a lot of data, and you think of it from a 45-day cycle, right? If you're looking at it on a 45-day cycle, you know, if we look at average P&Ls, let's say, right? Let's say over the course of 5 or 10 years, there are 8 45-day cycles in a year. Well, okay, how many 10-minute data? How many 10-minute periods are there in a day? Right, there's 3 for the first half hour, and then there's another 6 hours times 6, so 60 plus 3, 63. So in the amount of time you have this data, right, you have approximately, what is that, 48, call it 9 or 10 years, call it approximately 8 years of 45-day trade data, right, P&L.
Of
so
data
that's kind of what I'm talking about.
Yep.
So what we're doing is, and the cool thing is this data is in the time period you want to trade, right? This is like if you were trading 45-day periods in like, call it a 2022. You had 8 2022 years, right?
Yeah.
In 45-day time frame. Okay. We're going to compare these results on a 10-minute basis, standard deviation of P&L, best P&L for the 10 minutes, worst P&L for every 10 minutes, and the
This is interesting because it's comparing both long 0 days to expiration options and short 0 days to expiration options. So I'm curious to see how both of those compare, and then also just looking at what the other options that they've got here on the short side. The Iron Condor, for example, with the $2 wide wings, that's very similar to the trade that I placed today, and what kind of trade that I'm planning on doing for the Iron Condor. Because let's face it, I mean, unless you have some kind of insider information or it's some day that you can easily predict what the stock market might do, you don't know what direction it's going to go. And so really to be defined and to be directionless in your 0 days to expiration and let the probabilities play out, to me is the best play. So the Iron Condor there, I think fits perfectly for me because I can keep my capital requirement low, and then define my risk and not be directional.
The initial credit / debit, that's the start of the day only. And we're going to look at what was the general risk compared between strategies, which is the standard deviation. Number 2, what was the best 10-minute run you had and the worst 10-minute run you had. Okay, and we're going to compare that to the amount of money you paid for the trade or collected.
Beautiful.
I've got some guesses, but I'll save
You got some guesses.
I've got some
what
guesses.
are the guesses?
Well, best and worst volatility and P&L is going to be long call and long put, I think. Relative to initial credit debit, that's likely the same too, because you don't have any hedges on, where all these other ones you have hedges. That's my guess.
All right,
We'll see.
Nick?
We'll see though.
I'll follow Mikey. Yeah.
All right.
Yeah.
All right, let's go to the next slide. So we're going to take a look at the long, because there are a ton of these. So we're going to take a look at the long strategies first. We're going to look at the long call, put, the spreads, and the butterfly. So you are correct. Of course, the naked options had the largest P&L standard deviation, right? So you're going to have, and this is, remember, this is on a 10-minute basis. So you really have to consider the fact that, let's take a look at the initial debit of the call, for example. Now, the reason why the put has a little bit of a richer standard deviation is because, and this is the reason I show the chart, because again, the context of the day is very important. This is not going to be the same for every day. The reason the put had a larger standard deviation and a larger P&L swing is because the call lost its P&L or lost its values gradually in the first half of the day as the market sold off. But what happened in the second half of the day? You had that huge volatile price action with that rally in basically the mid-afternoon. Well, if you had a huge rally, a sudden rally in the mid-afternoon, of course, the worst P&L is going to be for what side? The put, the long put, and that's exactly what you saw, right? So you remember, the context is very important. That's why I showed the graph in the beginning. So standard deviation of P&L. The call and the put, call an average of $40, okay, plus minus for every 10 minutes. Now, keep in mind, you pay an average of $150 for this, for the call and put, the initial debit, right, for the at-the-money put. On a 10-minute basis, your average risk, this is your typical risk. So you have greater, you have much greater than this, and you also have narrower than this, but your average risk is about 25% of that debit paid. And that's pretty significant, considering that 25% of P&L is our average P&L for a 45-day period in its entirety, right? So, that...
I know this is the long strategies, but it says here, I just caught that, was the naked long strategies are carry twice the risk than defined. And that, again, reiterates the point of defined risk trades on 0 days to expiration just makes sense because you're limiting your risk and you can still get a decent return on it. And control that risk is really important on the 0 days to expiration.
This is kind of where you get the context of risk, right? Largest P&L swing is basically just the best P&L subtract the worst P&L, that kind of absolute value difference. $331 potential in largest swing for that put, right? If you have a huge 10-minute period and then the other side, the directly afterwards, you're basically having a P&L swing that's over double what you paid for the put in the beginning of the day, right? Now, call put spread and call butterfly will basically have about half the risk in total, and you don't have the outliers either, right? So what you're going to see here, and we're going to progress through this soon, but what you're going to see here is the long strategies, the naked strategies, and it's going to be the same for the short premium side, but the naked strategies carry twice the risk approximately on a 10-minute basis than the defined risk. Now, it doesn't seem like that much more in dollar terms, right? Because you're like, well, wait a second. It seems like the call and put spread should be much less risks than the naked options because you don't have any of the outlier losses or the gains, right? Remember, on a 10-minute basis, if you have twice the risk, that risk multiplies exponentially throughout the day. So whereas on a 10-minute basis, you may have twice the risk on those naked options, at the end of the day, you may have a risk that's about 10 to 20 times the defined risk trades.
Because you have profits on the table.
That's right, because you already have the compounding effect of the previous move.
So,
and you have like we said, 63 10-minute moves in a day. If you have twice the risk on each one of them, I mean, you do the math.
Exactly.
Right?
So what Anton's saying is if you have a dollar option, let's say it's a call option, and the ETF goes up and that option goes from $1 to $10, and now you're near the end of the day and you got an hour left of the day. If that option moves, your volatility is going to be way higher because you can go from $10 down to, back down to $1. That volatile move is even more volatile, compounded by the lessening of the amount of time that's left until expiration, which is at the end of the day.
Yep.
That's right.
And
So your risk compounds as you get closer to expiration, which is what we always talk about, how it's so hard to put a rule around this and say, okay, like you almost have to put a rule. Like you can't say, I'm going to wait for this, to 10x. Like you kind of have to have it set in your mind, all right, I'm going to take a double on this or a triple on this, or it's going to zero. You can't, it's very hard to manage the position on both sides, profit and loss.
Yeah.
Right.
And that's why it's a different mindset. Like if you're just buying long options, especially out of the money long options, like you cannot hold them to expiration on the 0 day.
Yeah.
You have to trade them intraday in these like little 10-minute spurts. Where if you had just a short call spread or even a long call or put spread or iron condor or something like that, you can hold it longer because you have the hedges on that reduces the volatility of P&L significantly. And if you have like a 0 day iron condor on, you can hold that through expiration because it's a different trade than just a long call or just a long put.
The volatility of your profit, though, is the part here, because it almost goes against you. The volatility starts to be a negative for you because, if you're profitable on it, it's all intrinsic value, and you can only make, you make that back with the move, and you have so much profit on the table that losing that profit is much more volatile than what you started with.
Correct.
Because that profit is marked on the table. Like everything's marked to market. So you start with $100, you turn it into $1,000. That's obviously a profitable move. But going from 1,000 back to 100 is a more volatile move than the move up because now it's profit off the table.
Yeah. It's like going to a blackjack table or poker table and tripling your money and staying there. You just can't do it. You have to
and then
plan
staying
an
there
exit.
and then putting it all in one bag.
Yeah. You have to plan your exit.
Yeah.
Go get a glass of water and then go to a different table where you re-enter with your initial debit and you manage your risk that way.
Yeah, it's betting $100 a hand, going from that to betting $1,000 a hand one time.
Yeah.
That's right, and you said it best, because as soon as you go from 100 to 1,000, you are carrying the entire $1,000 of risk on the table, regardless of the profit, right? The profit is incremental.
Yeah.
But when you carry that position, you're now carrying $1,000 of risk when you only started with 100, right? So, and that's, like you said, it's mark to market. So it is technically profits on the table that you could take off. So, and you this is a perfect example. Look at the put. The worst P&L swing, 10-minute swing for that put is $223. Your initial debit for that put yesterday was $135. So the worst swing in that option in a 10-minute period was almost double the amount that you paid for it.
Yeah.
That's exactly what we're saying. Mm-hmm. So let's take a look at the next slide. So number 5 is going to be very similar to these, except we're going to take a look at the short premium strategy. So same story with short premium, right? The strangle has about 2 to 3 times more risk on the standard deviation basis, the largest swing basis, a worst best P&L basis. And keep in mind that twice the risk on a 10-minute basis could compound to 10, 20, or even 30 times more risk for the entire day for the same exact, for the reasons we just discussed. So, all right.
Love it.
Last slide.
But yeah, they didn't cover too much of the short strategy here. We can see that the returns on the Iron Condor is less, but the worst P&L is less. That's really what I'm aiming for in my Iron Condor. P&L swing is much less as well, and that means I can lose less. Initial credit is just about half, so I need half the amount, which my buying power reduction was around 100 to 130 on my 0 days to expiration trade this morning. So that makes sense. You're able to limit that loss or limit the amount of capital that you have to put forward. And your best P&L was 40, so it's less. You're going to be getting less, but you're reducing the risk using that Iron Condor instead of the strangle. So I think that's, in general, that's the message for these 2 videos. Is the reason why you want to use an Iron Condor when you're trading 0 days is to define the risk, to define the amount of capital that you're going to use, and then let it play out in time, collect your profit when it works. And the idea is to win more than you lose because you're collecting less than what you can lose. And then if you, after so much time, my plan is, whether it's an hour or an hour and a half, if I haven't closed a position in a profit yet, then it's time to take it off the table. That's whether it's a winning trade or a losing trade. That's my game plan. So if you want to see more videos like this, more live streams like this, like the video or like the stream, you can subscribe for more. And I'm thinking about doing, I'll post a video about this, but I'm thinking about doing Tasty Live's Tasty Bites in the same kind of setting like this, doing the R&D room and going through a small account like Tom Sosnoff did in Tasty Live back in 2013. So he breaks it down very clearly what he would do in a small account and walks through what you need to know to make these trades, what he would do to make the trades. And so if you're interested in doing that, if you want to follow along, hit the subscribe button. Like I said, I will have a video posted going over the details on that. But that's what I'm kind of thinking about doing here, because eventually, you know, with the 0 days to expiration, you know, there's only so much information out there, especially with Tasty Live and the exact strategies that they do. And I feel like I've got a good handle on how I want to start doing the 0 days to expiration strategy, because I did do the one trade and it actually, you know, worked out for me. I think I closed my, I closed the video, but yeah, this trade that I made today worked out pretty well for me, doing that 558, 553. I think it was $2 wide, $2 or $3 wide on the short side, and then from the current price, and then I did $2 wide on the wings for that iron condor, and it was about an hour. We can see, we'll maybe not see it on here, but it closed within, yeah, there it is. So it closed just after an hour. Opened the trade at 9:04, closed it at 10:07, and I collected $12 there in an hour. So, hey, $12 an hour, that's not too bad, right? So, especially for trading. So, my limitation here for this strategy right now is going to be how many trades I can place in a week for the SPY. So I'll be looking out and seeing what opportunities I have. I heard Tom in the video we watched talking about, I think it was XPS. Is that the equivalent of, or XSP? Yeah. So that might be an option too, I think. If that's not, that could be counted as a day trade. I don't think that's a future. Yeah, I would say that's probably not a future. So I'd probably have to do, you know, like a mixture between the SPY and then the ES, or the micro ES for these types of strategies. It's probably going to be micro just because these are traded in increments of 5, and I know that's going to take a decent amount of capital there to be able to get anywhere with this. So if I did a $1 wide, what's that look like? Just kind of throwing that out there. Need to widen that out a little bit. So it's not too bad, really. If this is right, I know when the market's closed, it's a little bit different. And I don't know if I would do a trade exactly like this, but if I keep it wide like this and tight, then my max loss would be $100. And so it'd be hard to tell, you know, of course, with the market closed right now, but this could be an option. You know, doing the E-mini S&P 500, it is going to be a different iron condor, but a 0 days to expiration nonetheless. So will be kind of hard to tell. It's not going to be consistent just because I have a small account. You know, it's the limitations there. Because of the PDT rule, I can only do 3 trades a week. Let's see what this MES. I'm doing 1 days to expiration just because that's going to be the 0 days to expiration in the morning. So if I do something similar, or really I could do it like Tom did it in the interview we watched a couple days ago. See if that looks any different from last time. So yeah, this could be an option here, doing the micro. If I collected 20% of that, I don't know, like, and again, this is really just for learning purposes, because, you know, taking 20% of, you know, $37, that's going to be a really small amount there. So, and then with the commissions, it's probably going to eat it all up. But really, what I'm wanting to do is test, you know, how often do I win? When I win, just take the commissions aside. And when I win, how much do I win? Whenever I lose, how much do I lose? And how often do those occurrences happen? And I want to build up enough occurrences to where I can get an idea of how much or if this strategy is successful and to be able to continue trading this way. If it's not successful, I can try to manage the position, try to make adjustments. Maybe it's not an iron condor, but ultimately I want to make that decision of, hey, do I want to continue to learn doing 0 days to expiration in a small account, or is there a better opportunity somewhere else? And so that's what I'm kind of thinking too, doing the 0 days on a small scale, and then also doing the Tasty Bites, kind of learn and train from the Tasty Bites and take you along with me while I'm going through those videos to develop a good strategy for a small account like mine. And you can kind of follow along as I learn, and we can maybe learn something together. You can add some input on how you trade. We all, like, I think if you're a trader, you've started with a small account at some point, or started trading small at some point. And so if maybe you're further ahead along in your journey, then you can give us your input and your successes and failures. And I think that's the way that we can all learn something, get something out of it, and grow and learn how to do this thing. And we don't have to do it alone. So yeah, so that's 2 videos I wanted to watch. We want to do defined risk trades for 0 days to expiration. That is for sure. And I think the iron condor is the best way to do it. I'll try to send you a notification whenever I decide to do the next live stream. I don't have a set schedule yet, but I think I can eventually get a steady schedule on the live streams that I post, and then you'll know what to expect going on in the future. So we'll see you in the next video. Subscribe to follow along, and we'll see